Last week, we talked about the possibility of going back to the international gold standard by replacing gold with bitcoins. Today, we're going to talk about the agrarian culture 2.0. I guess history really does repeat itself. Today, we're going to talk about yield farming, the modern day agriculture. Instead of harvesting crops, we are going to be harvesting tokens. Today, we're going to be covering a few things, but mainly it's going to be the economics of yield farming. But before I dive into the economics of yield farming, I have to go through some understanding of what it is. So what is yield farming, the projects that are using yield farming, some tips and tricks, the good, bad and ugly, so you get to judge for yourself if yield farming is right for your project. Then we dive into the economics of yield farming from the perspective of token design, and then we can think about how you can apply it to your project. Part 1. What is yield farming? Yield farming is part of token distribution and network effects to get people and to get your user base into your protocol or into your project. In 2017, we had ICOs. We're using tokens as a crowdfunding mechanism and distribute tokens to founders. In 2019, we had IEOs. Similarly, we're using tokens as a way to fundraise and to distribute them via a third party, which are your different exchanges. Today, we have yield farming. We're using tokens to encourage transactions on the platform, and the tokens can have a utility in the future. Yield farming is not so different from exchange tokens. Check out the episode on the economics of BNB token, which is your Binance tokens. Basically, you are rewarded with native tokens by executing trade on the various protocols like Curve, Synthetics, Balancer, Compound. We are essentially mining native tokens by executing trade. Why is it so attractive? At the end of the day, it is attractive because the returns are so good. On a good day, you can have 100% returns in a single day. Of course, this doesn't come without risks. The losses can be very steep, but because it's so exciting, it's 100% returns, we have not seen that in a very long time. It has attracted millions of dollars into the market. Literally millions of dollars. Does it work? Absolutely. If it doesn't work, I won't be here talking to you about it. This native token is an incentive for liquidity providers. It is exactly what exchange platforms are doing with their native tokens to incentivize market makers. Yield farming incentivizes both borrowers and lenders to trade and transact on the platform. It works for users because they are rewarded with extra tokens, and it works for the projects because they're essentially onboarding new users for free. So why do people love it? As mentioned, people love it because you get a lot of returns. Instead of your normal interest rates that you get to receive, you are also getting extra tokens for free. So imagine you go to a supermarket and you see pasta selling buy one, get one free pasta. And when you buy the pasta, you realize that they are giving you pasta sauce for free. So this free pasta sauce is the extra native tokens. Let's move on to part 2, projects. This is nothing really new. Exchange platforms have been doing this for a long time, like Binance, BitMEX, and CoinFlex. But let's deep dive into 4 simple projects, and then we can understand a little bit more. So let's start off with Synthetics. Synthetics was probably the first to look into such mechanisms for users to earn extra tokens, extra native tokens, which is SNX. There are various liquidity pools, and users can get extra SNX by staking into these liquidity pools. So basically being a liquidity provider, LP. Users can earn interest on the various liquidity pools like Uniswap, Curve, Balancer, and then they earn SNX tokens. Why do they do that? To increase liquidity for the tokens, and in this case, let's say Synthetic ETH, SETH on Uniswap. Synthetic wanted to increase liquidity for Synthetic ETH on Uniswap. So whoever adds liquidity into the pool stakes of Synthetic ETH, they're rewarded with trading fees when people use SETH on Uniswap, and they also get SNX tokens. This high liquidity attracts a lot of investors. And I'm not talking about retail investors, I'm talking about more sophisticated investors. And this is a very, very good plus point for Synthetics, the ecosystem. So the underlying incentive for SNX is to increase liquidity in the asset. Did it work? Yes, it did work. The Synthetic ETH pool now makes up 1/3 of the Uniswap liquidity. The other project is Curve. Curve Finance facilitates trade between assets pegged to the same value. For example, in Curve Pool, you have USDC, USDT, DAI, and SUSD. They are all USD, so technically they are all the same price. There is also a liquidity pool that's backed by BTC, so you have SBTC, Run BTC, WBTC. All the prices are pegged to BTC. And instead of trading with people, Curve allows people to trade with the pool. The USP is that they have low slippage for assets. You earn fees by contributing to the pool, and the pool is then being lent out. By contributing to the pool, users get to earn interest rates when money is lent out, and they also get to earn transaction fees on the trade. How does Curve get action on this yield farming? Firstly, they're not issuing their tokens yet initially. Because everyone is trading so much, everyone requires liquidity, everyone started off with stable tokens to start the yield farming, because then you are hedging against volatility in token prices. So everyone required liquidity, and Curve came in to provide that liquidity for all these different pegged assets. Then liquidity providers also earn a lot of interest because of that, because of part one where everyone is demanding more. And now they are also giving out additional tokens, not just the Curve tokens, but also SNX tokens, Run tokens, Balancer tokens, and also Curve tokens. So these extra tokens are just not only native to Curve, but native tokens of other platforms. In general, all these native tokens are basically governance tokens. And 3, Compound. Compound is probably the protocol with the greatest transactions so far in the past 2 weeks. The total assets under Compound has surpassed MakerDAO as the top DeFi app. Compound is the primary market for decentralized money market. Compound is a protocol to clear borrowing and lending on various digital assets. So you can imagine why they are the center of this whole yield farming, because it's all about borrowing and lending. They issue comp tokens to lenders and borrowers, which is again a governance token. Anyone that lends or borrows on Compound gets to earn a certain amount of comp. Every day, there's a total of 2,880 comp tokens being given out, and it's distributed based on your trading volume. If each comp token is about $250, which is what the trade showed, then that's $720,000 in giveaway every single day. Now you can see why people are attracted to it, right? Because that's a lot of money being given out, and it's traded in the secondary market. It's listed on a lot of exchanges. So people are very interested to farm these yield. This resulted in 1 billion new assets flooded into the lending protocol to take advantage of this incentive. Last little project that we're going to dive into is Balancer. Balancer is an automated market maker, and users get to earn returns by providing liquidity. It's all about providing liquidity. Users get to earn native tokens when transacting and supplying liquidity into any of their 427 pools. This worked because the total locked value has increased tremendously. Before distribution, the volume traded is generally under $2 million. Since the distribution of the Balancer token to encourage trade, to incentivize trade, it is now 2 times to about $4 million in transaction. But on Saturday, June 28th, the volume shot up to 14 million, and this is a crazy growth. There's probably some attacks going on, there are probably some things going on in the back end, people exploiting different smart contracts and playing around with different tools. But this is working. You can see that this mechanism is working because it has increased trade by a significant amount. Part 3. How is this done? In general, you have a fixed amount of tokens minted daily or weekly by a smart contract, and then it is distributed according to the volume of each trader or user. So the more you trade, the more tokens you receive. Of course, it depends on the actions that you want to incentivize. Remember, at the end of the day, economics is about actions, about behaviors, and what kind of incentives or disincentives you can provide to alter people's behaviors. So for example, in synthetics, you want to increase liquidity. In Curve, you want to encourage trade. In Compound, you want to encourage more borrowing and lending. In Balancer, you want to increase liquidity providers. So based on that, you have your different mechanisms in place. In general, yield farming uses digital assets. So it started off with stable coins and assets that were super in demand because you earn interest rates, you earn native tokens, and you reduce your volatility exposure by the volatility of these assets. But as everything goes, the space became more crowded. You need to look for new alternatives to give you that kind of returns. So you farmers now move into the space where we're looking at assets that's more scarce, that's a little bit more limited, that doesn't have so much liquidity. So when you provide the liquidity, when you trade on that liquidity, you get more returns of the native tokens. So what are the assets that investors are looking at this week, or traders are looking at this week? Last week was all about stablecoins. This week is more about BET, about WBTC, about ZRX, about all these more scarce tokens, these tokens that are a bit more limited in supply. And one way to increase exposure, because if this exposure is not enough of trading these kind of very volatile assets, one way to increase exposure is the magic of leverage. InstaDebt helps you to increase leverage, so you can use leverage loans to borrow and lend to increase your exposure and increase your yield on native tokens. So before we go on to the good, bad, and ugly, I want to do a little bit of some hacks that I found online. The fun thing about DeFi is that when you find a loophole and you maximize your trade, you are known as a hacker. But in centralized finance, if you're an actual trader, you are rewarded with a huge bonus. In DeFi, it's a bit tricky because if you get too much, if you are earning too much, if you hack too much, you are kind of banished. So these are 2 simple hacks that I found. I want to give credit to 3 different Twitter users. You have DJN Spartan, you have DeFi Dad, and SNX Professor. And then you have so many more on Twitter, you can go and find them. So the first one is to earn 20% annualized returns of yield in SNX. How do you do that? You provide liquidity in smaller markets with less saturation and to earn yield, which means, going back to what I talked about before, it's about providing liquidity to projects or liquidity to assets that's a bit more scarce, a bit more limited. So stablecoin, initially you want to use stablecoin to reduce your exposure volatility, but you take this as USD, synthetic USD, because we're talking about SNX. You take synthetic USD into Curve Pool, and then take the native token that you are rewarded with. You deposit it in the synthetic minter contract to mint SNX. So that's how you get to earn SNX. The other one is, it's kind of a hack, but it's also quite dangerous, which is to switch assets based on the market volume. Once again, you start off with USDT because you want to reduce volatility of token prices, and then you just borrow and lend USDT. You can use InstaDebt to increase your leverage position and increase your yield. And if that is not enough risk, and you are looking at the market volume, and market volume has now moved to, let's say, BET, because BET is the most traded asset right now on Compound. If you want to increase your risk, increase your exposure, and increase your yield returns, then BET is currently giving out more comp on Compound, so you close your USDT stable position and switch to BET. Now you have increased your position, increased your leverage, increased your returns on yield, but you have also increased your risk, just so you know. So these are some little hacks here and there. It's not just about the very plain vanilla way. It's more of aggregating various tools that's available, your leverage tools, your DeFi tools available to kind of like a Lego, kind of build them together to build the kind of products that you want to give you the maximum returns, to give you the maximum percentage with the lowest risk and lowest volatility. And this is not easy. That's why, before I go into the economics of it, I want to give you a little bit understanding of the good, bad, and ugly. At the end of the day, in economics, there is no such thing as a free lunch. That's like economics 101. It's not about rainbows and butterflies and free money being thrown around. You have $780,000 being flooded into the market every day. No, it's not like that. It doesn't come for free. There are risks to it. Let's start off with the good, because the good is very easy, and the good is actually very good. The good is that these projects are way beyond the stage of just white paper. It's so easy to write a white paper. It's very difficult to validate the idea, and this is not just having a validation of idea, having an MVP, having a working protocol, working project, but users using it. So it's beyond your beta stage. This is a working product that can be used, and whatever the native token is, your yield farming is to get your user base, is to get your users on board. You can call it creative growth hacking. It's good. It works. Now let's move on to the bad. For the good, you can find more of the good parts online. Everyone is shilling it. So very easy to find the benefits of yield farming. But I want to tell you more about the economics, the bad side, before I tell you if you should do it or not. And then we talk about the economics and design. However, this is still a short-term incentive and it is not sustainable. What happens when the hype of trading is gone? What happens when transaction fees are too expensive and it makes no economical sense to trade? Which is something that's happening, by the way. Or when tokens are all given out. At the end, it is just a way to increase network effects and participation of users. It's like PayPal or Uber giving away $10 when you invite someone to join. Instead of a referral link, this is a collective hype movement to encourage someone to join this farming frenzy. Or perhaps it could be a Ponzi, a very long, well-elaborated Ponzi, if you think about it. But I'm not going to go into that part because I really don't think that there are Ponzi schemes. There could be Ponzi schemes out there designed and created based on these kind of models, but I don't think these projects are any of that. It just could be a Ponzi scheme. I think it just feels like this yield is a zero-sum game. If you don't know how to play, if you don't know how to leverage the tools available, then maybe you shouldn't participate. Because in the future, it could change by increasing the size of the pie, and then you just get bigger side of your pie. But right now, it seems like a beautiful zero-sum. Someone wins, someone loses. That means don't be the last sucker standing because you're going to suffer all the losses. And if you don't have insider knowledge, if you don't have a strategic advantage, if you don't have strategic position, if you don't have experience as a trader, then maybe you're not really earning yield. You are the yield instead. The real ugly part is the hidden strings attached. Due to all the trade going on Ethereum, gas fees has shot over the roof. It's the most expensive since 2018 with the whole ICO thing. I was looking at some comp that I have, and I wanted to transfer them to my MetaMask wallet, and it costs $9 in transaction fees to transfer it to my MetaMask wallet. That's very expensive. So just beware of gas fees, slippage fees, asset volatility. I also talked about leveraged borrowing just now. I don't want to dive too much into it because this podcast series is not for traders. It's more for crypto entrepreneurs and it's more for long-term investors. Leveraged trading can be good to secure very good upsides and give you exposure, but the downside is that the losses can be very steep, especially since the market is crazy volatile and you can get squeezed up very easily if you have all your liquidity tied up in the DeFi apps. There's a tutorial, I would link it, by DeFi Dad to reduce liquidity risk. But this is something that is very prevalent, it's out there, and if you don't know how to deal with that, maybe you should avoid it. And that's why initially stablecoins, in fact until now, stablecoins are so much in demand because it helps you to reduce your volatility and to reduce your risks. But if you're expert, if you know how to play this game, this is how you rule, how you play, then go for it. There are a lot of ways to increase volatility, increase your position, and increase your returns. You just have to play around, understand how all these different apps work, piece them together like Lego bricks, and you're good to go. And also, you can read all about the 100% returns, which a lot of people are actually shilling. But remember that there's no yield guarantee. No one is going to guarantee that. Not the project, not the founders, not the crypto entrepreneurs, not the crypto traders, not random people on Twitter. No one can guarantee that. The market decides and the market moves very quickly and it is very risky. And finally, something more in the long run, something that I think is very, very important. Well, economists always looking at the long run. Because there are so many transactions going on, may or may not be inflated, transaction fees are very expensive now. So on the EIP, the Ethereum miners are looking to increase the block size. This is great for validators because in the short run, they get to increase their returns. Because you increase the block size, you get to approve more transactions. It's in general great. But there are a lot of downsides to that. It it makes Ethereum network a lot more vulnerable to attacks on the network. And then there are a lot of economic stuff that I will not go into in this episode because that's not what we're talking about, but the underlying protocol, a lot of possible crypto economics attacks available there when you increase your block size by too much. So these are things that you need to consider because it's very good in the short run. In the short run, everyone is happy, everyone is good. But in the long run, there are consequences to that. Is it sustainable? Is it robust? Are there some other risks that we're not thinking about? There are a lot of things over there that is beyond just short-term hypes, short-term crazy farming yields. So now let's dive deeper into the economics. Since yield farming is part of token design, we will only look at the token design column of the token economics framework. This is not exactly something brand new because we see similar models also in the physical fiat world. You've got churning of credit card points to, you just buy you subscribe to a lot of credit cards, you spend on different things to get your credit card points, then you cancel your credit card. Or you can have, the frequent flyer points hack, flying from A to B to C instead of flying from A to C to get your miles so that you can get a free upgrade to first class in your next flight. So these hacks are not absolutely new. And this is where the fun comes in. At the end of the day, this is a self-reinforcing mechanism. This token model that is being designed is a self-reinforcing mechanism, which is good because when everything goes up, everything is good. But when it goes down, you have this spiral towards death. Let's talk about the good side. The token incentives create liquidity that starts a feedback loop. When trading volume goes up, market making profit goes up, then you want to dedicate more of your money into market making, liquidity goes up, spread tightens, get more people coming in, you get investors coming in, you get trade coming in, and then trading volume goes up, and then you go around the circle again and again and again. So let's take into an example of comp tokens. Let's put that into perspective where you have comp tokens as a different incentive to help this feedback loop. So users lend an asset to receive yield. Let's say 10% yield depending on the market. And then the borrowers must pay interest, but they also get the comp token. This comp token, the native token of Compound, has been increasing in value. It started at $16 and once it's listed, it was $250. And it hit almost $350 at one point. So there is a value in that. And the value keeps increasing. The value of comp tokens keep increasing. Why? Because the market perceives the economic value being extracted from the Compound platform is now turned into monetary terms in form of the comp tokens. And that's why we see the value of comp tokens increasing in the secondary market because of what the market perceives. So what happens? When the returns of comp, the price of comp keeps increasing, and the price is so much more than the interest you're paying as a borrower, because borrower, you have to pay interest. If that is so much more than the interest that you're paying, you're basically earning money to borrow. Compound is basically paying you money to borrow on Compound. And then it becomes a loop. And then not only does trading volume goes up because liquidity and spread tightens, now you have an incentive. It's almost like a subsidy giving you money to be trading. And this just keeps emphasizing this little circle. So is there a real economic value? At the end of the day, this method just encourages network effects without providing any real economic value. For protocols and projects to succeed, it depends on the builders and the users to stay on the platform for a long time and not just this movement. This is not to say that this is completely a fake project. This is to say that this incentive mechanism, this short-term self-reinforcing mechanism can be used to help to build users and bring builders onto the platform so that they will stay for a long time. But this is not sustainable. This short-term thing is not a long-term solution. Does it work though? Yes. It seems to be working in the short run for now, as it was designed to do so. A short-run incentive. Comp token has increased from $16 to $230 upon listing, and it's a feedback loop because people want to mint more, farm more comp tokens, and it reached the highest of $350. This leads to more comp being locked up, and you know how much is being locked up? $400 million is locked up in Compound's protocol. And that is so much more because 1 week ago, in fact, 1.5 weeks ago, it was just 100 million. So that's 4 times increase in the total asset value being locked up in Compound project. But is this sustainable? Yes and no, because yes, it's sustainable for now because we see an upward trend of Compound prices, but we also see that there's a downward trend in the past few days showing that it's not that sustainable. So maybe it will reach a bit more of an equilibrium, hopefully, and it doesn't go way too down. At the end of the day, this is a token supply increase or supply inflation, which is very different from price inflation, though makes them up very different. It is distributed to users based on the trading volume percentage. The supply inflation is usually decided by the protocol founders. For example, COM has a distribution of 2,880 tokens every single day, and Balancer is issuing 145,000 Balancer protocols or Balancer tokens every week. This could perhaps change in the future since these tokens are generally governance tokens, and we'll see that in the future. Instead of people paying for tokens through crowdfunding and IEOs and ICOs, it is earned via the platform. So it is technically free in the sense that you use it for its purpose and not to speculate and inflate your yield returns. Then people are using leverage to increase their trading exposure to mine these tokens. So let's talk a little bit more about the return of tokens or return of investment for early investors. These tokens are not exactly free. Early investors, I mean way early investors, they have invested into the projects and they receive tokens. And they are happy for these tokens to increase in value because then they can be cashing out and selling them on the secondary market. Unless you have a strategic plan for using these tokens to leverage these tokens to gain extra returns, you are just part of this plan. You're basically the yield. If we compare this to IPOs, usually in IPOs, there's this thing called IPO pop, where the value of the stock increases when the stocks are listed. And people trade it. And the thing is, people already own some of these equity before the stock is listed. If you have no idea how to use that to your advantage, if you have no idea how to get extra insider information, then maybe you need to rethink your position of joining the game. It might be even worse in DeFi or even riskier in DeFi because tokens are not equity in DeFi. Sure, governance token gives you some flavor of equity, but at the end of the day, tokens are not equity, and so there is no legal mandate to protect token holders or these equity holders because they are just two different things. Token holders and owners of equities of a project or a company is very different when it comes to regulation. So just be careful when you are interested in joining this entire project. Let's talk a little bit more about transaction activities because that's probably one of the crux. At the end of the day, all of them are looking at liquidity providers and how to increase liquidity providers. And why do they want to do that? Because there's trading going on, there's transactions going on, there's borrowing and lending. That's the ultimate thing. They want to increase borrowing and lending. So borrowers are willing to pay more because they think they can make more money, as I mentioned earlier. They can make more money by earning or farming more native tokens than what they borrow, which is the cost to borrow it, the interest rates payable. So borrowing fees are basically subsidized with the native token since there's a value to it. And instead of a cashback, think of having a credit card, and when you spend on your shopping, you get cashback. Instead of a cashback, you get a token back. So it's a token. The cashback is in the form of a native token. This native token cashback can be worth more than the fees paid. So that means now people are incentivized to borrow money just to farm the cashback or just to get this cashback. This increases demand for loan and then increases how much lenders can earn. And lenders, for lenders is very good. It's all plus points because more people are borrowing means the interest rates is increasing and more people borrowing means you get more cashback. And that is why people say that you can get, 100% the yield because you're not only getting yield as a lender, which is the 2 times, increase in returns of interest and increase in cashback, but you're also getting subsidized as a borrower to be borrowing money or to be borrowing on these platforms. So that's what people mean by 100% returns. It's not just being a borrower and a lender, but being a borrower and a lender and leveraging your position to be borrowing and lending. So just take note of that and don't just dive into it just because all the numbers sound so attractive. There are a lot of risks to it. So how do you apply it to your project? This is a typical method of issuing tokens based on transaction volume, as we see in exchange tokens. Check out the BNB episode for the economics of that. Yield farming is a growth hacking way of achieving network effects. It uses short-term incentives to drive user growth. At the end of the day, we are looking at the bigger game. In the long run, how sustainable these platforms will be. The real economic value comes from building projects and building products that benefit users in a sustainable way and not just hypes and pumps. This means actual financial activity for DeFi protocols so that monetary value increase is not just driven by sophisticated leverage speculation, which is what you're doing right now, but real value add. So think of this as not the answer to how to increase your token prices or how to look at distribution. Think of this as a mechanism, as a method to reach your end goal. This is a means to an end, and this is not an end itself. If you want more details about how to build a token economy, check out our course. You can scan the QR code or just go to the URL. We're currently having a discount. It's a 15 hours course with 10 episodes. You can just pick and choose based on what topics you're interested in. So I'll see you in that course, and I'll see you next week. Bye!